Interest rates in the UK are currently higher than they've been for over a decade. For mortgages, this is bad news, but for cash savings, this is great news. So in this video, I'm giving you some high yield savings accounts that you should consider to help you grow your cash savings. Hello there, welcome to FinBright channel. I'm so glad to have you here. The main purpose of this channel is to build a financially literate community. Let's get started with today's topic. Now, the first thing I would like you to do now is to take your time to find out exactly what you are earning on your savings account. If you've got some money stashed away in your savings account, but you have no idea about the interest rate, or maybe you haven't checked in a long while, this is the perfect time for you to check, okay? I'm just saying this because you really need to know your base, okay? Let's consider some of the high yield savings accounts and their interest rates as at the time of making this video. Note, I will be giving you all these figures from my Moneybox account, and this may differ from other banks or other financial service providers. So always feel free to shop around for higher rates and move your money wherever it works harder, okay? The first savings account I'll be talking about is the Simple Saver with 2.9% variable rate. Variable means that it changes. For instance, if the Bank of England changes its interest rates, the financial service providers will also change their interest rate accordingly. They will adjust it. Anyway, for me, I will not be putting my money in this savings account simply because the interest rate is lower than the current inflation rate at the point of making this video. The current inflation rate is 3.54%, even though the Bank of England is working so hard to bring it down to 2%. So now you understand why it is good to be financially literate, so you don't leave your money where inflation is eating it up. This is one mistake most savers and investors make. Your money will be losing value in such places. The next account to consider is the 32-day notice with 4.2%. Actually 4.24%. This is a good one because the interest rate is at least higher than the inflation rate. Another one to consider is the 95-day notice period savings account. This is also a good one because, of course, the interest rate is also higher than the inflation rate, so your money is working hard for you. However, for both the 32-day and the 92-day notice, it simply means that you don't easily access the money. So if you want to withdraw any amount, it will take either 32 or 95 days respectively before it lands to your bank account. So you see, such high yield savings come with a price, so make sure you are only keeping money you don't always need in this account. I forgot to mention, for the Simple Savings account, you are able to withdraw at least once every month, but you won't be able to withdraw more than once in a month. So these accounts, these high yield savings accounts, they are not for everyday shopping, they are not for everyday expenses, okay? They are just for the money you want to keep for a particular length of time, just as you are saving up your money. They are not easily accessible. That's just it. The next one I would love to talk about is Cash ISA with 4.2% interest rate. Now, I love this because it is easily accessible in that when you apply to withdraw your money, you are able to get the money instantly, or maybe within 24 hours. You are not given any notice period. However, you can only withdraw 3 times in a year. If you withdraw more than that, the interest rate drops. So you make sure you don't always have the need to withdraw the money from this account. Now, unlike the notice period account, whenever you withdraw, you receive it instantly. That is what I love about this one. So now, I hope you understand why I want you to confirm your rate first because you could already be earning more interest than you think. And if you are not earning a great rate wherever you are, you at least have a base level of what you are currently earning before you start looking at other accounts from different providers. Now, you should make a habit of regularly shopping around. because in a high interest environment, complacency with your personal finances can really cost you. So I must make you aware of this, because high street banks, they are unlikely to provide the very best interest rates on the markets. So it is important for you to look into a number of providers and be prepared to move your money to maximize the interest you are earning on your savings. This could be the best time for you to take action if you haven't already, just to ensure your money is in the best account to help you achieve your goals. As at the time of making this video, which is on the 19th of June, on a Thursday, the Bank of England is somewhere making the decision of the interest rate right now. So you see, things are changing. I mean, they make these decisions like, I mean, the last one was just early May, and this is June, and they are making another decision. So you see, their decision affects the inflation rate, it affects the interest rate, you know, and this whole thing affects how our money is working in, and it also affects the interest rates at which we are able to borrow or get mortgages. And so that is why you should be on top of the game. Like, if you really want to be wealthy, it's either you know these things or you outsource it to an accountant or a financial expert to be managing your resources. Nobody knows how long rates will remain as high as they currently are. So right now could be the best time to take action, if you haven't already, to ensure your money is in the right or the best account, just to help you achieve your financial goals. The next thing I want to discuss are the factors that can affect the interest rates offered on savings accounts. Now, these include the provider. Like I said, high street banks, they will offer you a lower rate than other providers, I'm telling you. Number two is how flexible the product is. For instance, if the product is easily accessible, you find that it comes with a much lower rate. Just check it out. The simple savings account I explained just a while ago, it comes with the lowest rate of 2.9%. Why? Because you can withdraw money from it at least once every month. However, for the other three, you do not have that kind of access to their account. So you understand how flexibility of the product affects the interest rate. So the third factor is how easily you can access your savings. Like I said, easy access savings account will likely offer you a lower interest rate than a short-term notice account or a fixed-term savings account. So I hope this is quite clear to you, and you make your decision. So be sure to maximize the interest rate you earn on your savings by matching the term of your deposit with the time frame of your goals. For example, if you are saving for your 2026 holiday, you will know roughly how far away in the future you want or you need access to that savings, and then you can now decide exactly which one to go for. In summary, savings should go hand in hand with investing. Just try as much as possible to find the right balance between allocating your money to cash savings and investing. Both savings and investing, they are well suited to help you achieve different financial goals. For your savings, it should be where your short to medium term money is. Okay, for example, your emergency fund, your savings for home improvements, or your next holiday, whatever it is, even your wedding. Investing, on the other hand, can help you achieve financial freedom over the long term. Please note, over long term. Remember that compared to savings, investing carries risk, and you might get back less money than whatever you have put in if you don't stick to a long-term time frame. Okay, so I want to reiterate that you shouldn't forget about the impact of inflation. Whatever you do, don't forget this. It is one of the biggest mistakes savers and investors make, because inflation has a very real effect on the value of your money. Whether you like it or yes, it has an effect. When the interest rate on your savings or the returns on your investments are lower than the inflation, your money is losing purchasing power. Okay, so even though there is no sure way to protect your money from the effects of inflation, it's always important for you to confront your reality rather than remain ignorant of it. Always calculate your real returns. That is the current rate of inflation minus the current interest rate you are earning on your savings. So you can take this into consideration when you are tracking your progress against your financial goals. I have given a lot of examples and I hope you understood. Otherwise, feel free to ask me on the comment section and I am here to, clarify whatever confusion you have. And that's a wrap, my people. I hope these tips will help you move forward with your financial goals with confidence and empower you to make beneficial decisions. Okay, make sure to check out my other videos for more tips and how to achieve your goals, whatever they are. And I will see you in my next video. Bye bye. Thanks for being here.